Hello, and welcome to a very special Qredible Live webinar. As always, I'm here with our CEO and Chairman, Brian Fitzpatrick, and this week we are joined by two very special guests. Mike Goral is the National Cannabis and Hemp Tax Partner in charge at Armanino LLP, and Colin Campbell is the Managing Partner at Campfire Advisors. Our question for the day is, where is the money? We're going to discuss Benzinga, rescheduling, and all things finance and capital in the cannabis industry. Thank you both for being on the show today with us. To get us started, let's start with Mike. Could you tell us a little bit more about your background and the work that you're currently doing?
Thank you, Taylor. Yes, I lead Armanino's cannabis practice nationally for the firm. We are a national accounting firm, and we provide everything from bookkeeping services to tax and audit, as well as IT consulting services to the cannabis industry in all states where it's legal.
I called him earlier. I called him the tax goat, and I was trying to tell him he's not an old goat. He is just the greatest of all time in the tax side. So it's all good.
Thank you, Brian.
Yeah. Colin, tell us about yourself.
Yeah, so I'm the managing partner at Campfire Advisors. We are a boutique investment bank focused on the lower and middle market space. We provide M&A services, both buy side and sell side, capital placement, both debt and equity, and then some strategic consulting services as well.
Awesome. Well, it's great to have you guys. This has been a topic that has been near and dear to me and many, many people in the cannabis industry. And I wanted to sort of start with talking about Benzinga, because I understand there was a bit of a different vibe out there. And Mike, can you give us your perspective on what you saw out there this year? Yeah,
I mean, it was, the mood was just kind of like subtle. The excitement of these conferences in prior years has kind of gone away. It's now survival of the fittest that is now, standing around and able to continue their operations. And I just think that, the audience, it just seemed like it was about half as much as it normally would be. The vendors were half as much as well, so it was just half the show it used to be. And I think that, a lot of cannabis companies are obviously still looking for funding, but I think investors and that market is on pause until after the elections and after the DEA's hearing on December 2nd.
So we're sort of in a wait and see mode. What were you hearing, Colin? Anything you heard out of the conference? I know you had a bunch of meetings out there.
Yeah, it was really interesting timing, the way everything sort of fell together, right? So we've been hoping for the Fed to start lowering rates, the impact on that having a lower cost of capital, obviously that helping M&A and capital markets, but this highly politicized election that's been looming over our heads all year long, getting closer and closer. My sense was this sort of growing, swelling support for the industry with anticipation that we're going to get things like rescheduling that would have created a lot of optimism. And then at the same time, you have some unfortunate headlines. And I sit out here in Southern California, so in the sort of West Coast ecosystem, the headlines obviously are highly oriented around, State House and Gold Flora and really good companies that we look at and go, even they are having their challenges, right? And so I think it was a bit of a mixed bag, was my sense. And to Mike's point, many of the folks that are still in the industry are the ones that have survived, and they are more seasoned, they are more battle hardened. And so for many of us, it's been this emotional roller coaster as you hope for things like SAFE and then SAFER to get done. You hope for things like rescheduling, and then everything sort of goes on hold. I think the capital markets more generally, we saw a window probably in Q1, Q2, where we thought we'd see a lot more activity. And in fact, we did. And then coming into the end of Q2, Q3, I think you see a lot of that just pull back for exactly that reason, right? It's just very much a wait and see. The capital markets, as we all know, generally hate uncertainty. And we have plenty of uncertainty right now. So
Yeah, it's
really interesting.
It really is. It's just a strange but interesting environment. And one of the things that I really like about both of you is that you're really industry pragmatists. You know, it's and often I don't get that when I'm speaking in the sort of other investment bankers, Colin, is, you know, you're either getting one or the other, but you have a very kind of steady view that's based on and it's like, to me, it's like an unemotional, you know, kind of take on the industry. And I've really enjoyed that perspective. So, I mean, when I ask you these things, it's like none of us really know, but you know, what is the take? What is your take on rescheduling? Is this going to happen, or is it just going to get kicked? The can's going to get kicked down the road again?
You know, you know, and you may not like this answer, but I think if we zoom out and we put it in context of everything that's going on from a geopolitical standpoint, you've got two really significant wars. You've got a government that is struggling to pass any sort of budget. You've got political parties that are at each other's throats and at their own throats in some cases. It's really, really hard to say what's going to happen with this. And unfortunately, the industry has been whipsawed back and forth over the last few years with this you know, tantalizing opportunity to get real meaningful legislation passed, only to then see it get traded away for something else. And so part of me fears that, is this more of that, not a bait and switch, but sort of that tease, and it ultimately gets traded away? And I can see that happening when you put it in context of everything else that's going on. Is our industry just not rising to the priority that it needs to get the representation? Maybe, but at the same time, now look at just the general support across the country. Look at the level of legal consumer use across the country. Look at the states that are flipping from you know, no market to medical market, or medical to adult rec. The momentum continues to build. We're all headed in one direction. It's not a matter of if, it's a matter of when. I just can't say when it ultimately happens.
Well, that's how about you, Mike? What are your thoughts?
Yeah, you know, I kind of echo the thoughts that Colin just mentioned, and I would add to it that one of the other things that's kind of holding the industry back is what's going to happen with hemp, because you know, there are so many companies that are now making beverages and other products out of hemp and selling them legally across state lines, you know, without any regulation. You know, there's nothing really, you know, testing, none of that is done. It's just all self done. And I think that creates additional, you know, pressure on this industry as to like, well, you know, is the hemp companies going to take over the cannabis companies? And there's a lot of cannabis companies now that are investing in hemp because they see, hey, why do we need to go through all the regulations and taxation and issues that we have with cannabis when we can just do this as hemp? And, you know, it's a free for all.
Right. That's for sure. And one of the things that I follow is the ATB Cannabis Investor Sentiment Survey, and which they just completed the 2024 results. And you know what we're seeing is a softened sentiment on MSOs. So only 31.8% of the respondents reported of the investors that they surveyed reported being more bullish on multi-state operators compared to just 6 months ago. So it's down from 83.3% down to 31.8% from their spring survey. And just 9.1% of respondents reported increased net exposure to the MSO sector over the past 6 months compared to 61% in the previous survey. So what do you think are the factors that are really driving that? Because that's like a huge, you know, plummet. And I was feeling more confident, you know, coming into 2024, and these results aren't showing it.
Mike, do you want to take that one, or shall I?
Yeah. Well, I'll make a quick comment, but I think you might have a better perspective on this. I think it's just because, you know, these companies have a lot of debt. They have, you know, a lot of debt that's coming up for restructuring, and these 5-year loans and things that they have is really hurting their balance sheets and keeping them from being investable companies.
Well, we're going to talk a little bit about that later on, but it seems like that's like one of the only options, right, to many of these people. And when you look at, I've talked to some multi-state operators. When you look at it, it's sort of like, they're borrowing from the mob. I mean, when you look at some of the interest rates that and the debt service is just absolutely, I mean, it's crushing. It's crazy. And I agree with you. That's got to have something to do with it. Colin, what do you think?
Yeah, I mean, I think so. Coming into the year, there was a lot of optimism, right? I think we've continued to see unfortunately, the Fed, I would argue, could have potentially lowered rates more quickly. And so we were hoping to see that in Q2. It didn't come until September. And then it was done in a very politicized environment, which I think made it very complicated for them. So I think part of what your numbers may be picking up is that the wane of that optimism and then the impact of that late decrease. I think the market also became much more sophisticated over the last year plus in terms of the investor set looking at these opportunities. And so I go back to one of the last big announcements. I think it was when the DEA came back and said, we're seriously looking at this, or the HHS came out and said, we believe it should be rescheduled. You saw a lot of volume change hands in the market, and you saw the prices increase very quickly in the market, and then you saw it fall back. Those stocks largely gave up all of their gains within about a 48-hour period. So that looks to me like that is a lot of fatigued money getting out and new, maybe overly optimistic money coming in, and it ends up being a net swap. And so I think you have some rotation. You have a tremendous amount of just fatigue across the operators in the space. And I think that all sort of plays into it, right? I think separately, then you progress through the way the market is being, or the industry is being described by some of our candidates. And it implies that there's a good likelihood that this remains deferred to the state level, which a lot of people would argue that just means it's more status quo, right? And that really doesn't change our situation at all. So is it conceivable that over the course of this year, sentiment has shifted because more and more people are recognizing there is a real probability that we have, I hate to say 4 more years, but some more period of just sort of the same? I think that's part of it, right?
Well, it's interesting because the other thing that's sort of come down when I looked at that survey is it was 76% of investors were assigning a probability of their confidence in rescheduling, and now it's down to 62%. But when we look at that rescheduling, I think that there might be a take in the market that if that happens, it's just going to be this boon of investment capital coming in. And I think it was 32% ranked rescheduling cannabis to Schedule 3 as a top factor. 60% of respondents ranked uplistings to U.S. exchanges as the top factor that would, really give them satisfaction. But I mean, you can't get on a U.S. exchange without the federal prohibition being lifted, right? So that's a we can't even predict when that's going to happen. I mean, that could be 7 to 10 years, but at least we'll see some confidence with rescheduling if we move to Schedule 3. But we also see investor confidence being down that it's going to happen within the next 12 months. So that seems to be waning. I mean, do you think that's going to be a big boon if it does happen, or do you sort of believe that only like 31% really rank that as a top factor?
No, I think there's a real likelihood, there's a real potential that it could happen, right? I think if we've learned anything over the last, call it 5+ years, it's that our state and federal governments know no bounds in their ability to frustrate and disappoint. And so I am one that I've been a fairly vocal proponent of build a business that works and operates and functions correctly in the market as it exists today, because you cannot depend on any government agency or body to change the rules in your favor on any set timeline.
Right.
And so, yes, I am optimistic that it will happen. I am absolutely still bullish on the industry, but I think prudent operators today are setting themselves up in the market in which they operate in today.
Right. And we're seeing, I think the stat was 27%, only 27% of cannabis companies in the US are actually making a profit. So when you look at that, it's like I see this sort of as a snowball effect. So is it rescheduling that's going to build investor confidence, that in and of itself? No, but I think it's going to, if we get rid of 280E, right, as a result of the rescheduling, which Mike has educated me that don't expect the impact of that to be immediate. It's going to take a little while to trickle down. But when that does start to trickle into the market, I got to believe that 27% of companies are going to improve as far as the percentage of companies making money, and overall the profitability and the sort of the optics of the industry are going to be what drives investor confidence. I mean, Mike, we've had a lot of chats about that.
Yeah.
I mean, would you think that's going to be a big impact? It's really the impact of 280E.
Yeah, exactly. Because that was one of the things that were really optimistic at Benzinga, was that they were saying that, hey, if cannabis gets rescheduled from 1 to 3, then overnight the valuations of these companies are going to double, maybe even triple from their current values. And there was a lot of optimism that this was going to happen, and then that would help these companies with their balance sheets immediately. They wouldn't have to make estimated tax payments as large as they have now. So cash flow improves immediately. So it really is going to be dependent upon when this descheduling occurs. My worry is that, if the hearing with the DEA is December 2nd, then I don't know if, they'll be able to promulgate enough regs and rules to make it effective, say, January 1, 2025. And if they don't make it effective as of January of 25, then it will be probably January of 26 before it becomes effective, giving us yet another year of limbo waiting for all this to change. And, it's just really unfortunate. I think some of these large MSOs have taken positions that, hey, we're so close to this being descheduled that they're now starting to file tax returns without 280E, knowing full well it's still in effect. And then the IRS put out a promulgation, I want to say it was in late June or so, that said, look, all this talk about rescheduling doesn't matter because the law as it stands right now is 280E is in effect. We're going to enforce 280E until this thing changes, and then there'll be an effective date, and then it will change. But up until then, it's going to stay this way.
Yeah. And the other thing is, I don't know how many of our listeners follow the MSOS ETF. It's sort of that fund of the public cannabis companies. But what I had seen there is that 53.3% of investors believe that if rescheduling happens, that fund would rise above $20, which would basically be almost a 200% increase from its current level. So there seems to be people are sort of banking on that, that if that happens, then these undervalued companies, could really see a large surge. And that's one of the other things, is that there's a big belief that these companies are significantly undervalued today. So they believe that, that the big impact is going to be rescheduling, because I think there's a pretty large percentage that believe that most of the companies out there are currently undervalued. What are your thoughts about that, Colin?
So let's talk about that for a minute, right? I think yes, they are likely undervalued because they face all of these regulatory and tax headwinds, and the tax environment in particular is just incredibly onerous. And I think Mike and I could probably go on a longer rant about all of the accrued tax liabilities and how that's going to get treated, and the private companies that are looking at public companies as examples and then trying to repeat that and not pay their 280E, and how complicated that makes capital raising and M&A, right? Setting all of that aside, there was a time where the market, and we heard a number of analysts out there talk about public MSOs and private cannabis companies as the equivalent of these high growth consumer tech type brands. The reality is that they are not. And most of these MSOs are trying to be vertical in their independent individual state markets, which creates in a traditional industry a tremendous amount of overinvestment, capital inefficiency, because you're now building vertical capabilities in each of these states that, assuming we zoom out far enough and you get interstate, you get federal legality, you don't need all of that infrastructure. And so it's interesting when you look at different public MSOs, some are taking a very sort of asset light model where they've already done their sale leasebacks. They are leasing the infrastructure and the real estate in order to be vertical, and they've signed themselves up for long-term liabilities. Others are arguably, maybe more prudently, managing their balance sheet and still owning the actual assets so that when the time comes, they can sell those, right, and de-lever that balance sheet. And they can right-size the balance sheet and the operations of the business for the new capital efficient market that exists then. Again, none of us know when that's actually going to happen, but maybe that gives them more optionality at the cost of maybe less fuel for that growth in the near term. And so it's interesting to see that balance. The other thing I want to touch on with MSOS is, I did this analysis, maybe it's dated now, maybe 18 months ago. And at the time, I think there was something like 350 public companies listed between the US and Canada. And I would argue that maybe 10 of them had any reason to be public at all. The rest were small, they were micro. The cost of being public, Mike would know better than I would, but I'm guessing it's meaningful. And so I can't see how that merits them being public. So when we talk about MSOS, I don't know the actual mix of that fund, but my sense is that it's largely skewed towards a very small basket of big public MSOs. And so do they stand to benefit from rescheduling? Certainly, right? And I think 280E is a big piece of that. But uplisting eventually will be a big piece of that. But there again, what is their actual logical value in a normal market? Take the word cannabis out of it and make them, consider them apparel companies or any other CPG company. Where should they be trading? GE is an example of a company that earlier this year broke apart other pieces of its business and spun them out into separate entities. Mm-hmm. Why? Because a straightforward, simple business with a focus on one clear operating model and objective is far easier to understand, it's far easier to finance, and it's far easier to value than some conglomerate of a lot of different things. Very few operators, and most of our clients are private operators in the cannabis space. And so it's very difficult to find operators that are really top-notch at cultivation, manufacturing, product, branding, retail, all the way through the supply chain without creating some level of inefficiency and waste, right? And so I think there again, will MSOs benefit from rescheduling? Certainly. Will we see a disintermediation of the supply chain eventually into these components with really expert and differentiated, cultivators, different from manufacturers, different from retailers? I think we probably will. So the face of what an MSO probably looks like today could look dramatically different in 5 years.
That's a great perspective. I love that perspective. And the number that I was looking for, it's 59% of investors see these tier one MSOs as undervalued. So it's those tier one despite the overall neutral sentiment. So we've got this neutral sentiment in the industry. So it just seems like there's got to be a lot of money sitting on the sidelines that's sort of waiting. So we know that I think everybody can agree. I mean, that there's a lot of money sitting on the sidelines waiting to see what happens, right? Mm-hmm. The question is, so the money that's in the game right now, what do these transaction structures look like? Because I'm seeing a tremendous amount of debt structures out there. And personally, this is my fourth company. And I mean, I almost had a near-death experience at one of them with too much debt. And I promised myself I'm never going to get in that situation again. It was very, very uncomfortable. And so I manage, I don't ever really take on a lot of debt. But is it the only option for these companies? I mean, what are the most common transaction structures that you see that are used for these cannabis businesses that are trying to raise capital?
Mike, did you want to take this one, or?
Well, yeah, I mean, what I see at least is it's all debt. No one wants any of the equity, and so they're doing not only debt, but they're doing short-term debt. So they're not going to get, a 10-year loan or anything like that. It's going to be 5 years or less, and they want that loan to be secured with real property or some sort of equipment, whatever assets that could be then at least sold for salvage value and get some of that money back if things go south.
And I'm also seeing personal guarantees. Even if the company has assets, I'm seeing personal guarantees being signed by some of these principals. I mean, so it's sort of like they got belt and suspenders for some of those debt deals. And then the price of them seem to be crazy. I mean, really high.
Yeah, there are. And they can charge those rates because, until you get to the usury rates, it's what the market will bear. And no one wants to take on this risk. There's just too much out there where companies have failed. Like MedMen is a great example of, you could see, they had so much debt that it just crushed them. And now, there are issues with, being able to, unwind that company that was such a great brand.
Mm-hmm. Yeah, that's true. What are your thoughts, Colin?
I think that's right. I think it's largely debt right now. It's largely all senior secured, backed by real, asset collateral packages. Licenses used to have collateral value. They don't. Equipment used to have collateral value. They really don't. I think, there's a limited number of institutional investors that can play in the space, and they've created separate vehicles with kind of curated lists of LPs that allow them to go in and invest in the space. But you have a tremendous amount of the traditional venture and private equity market that just can't touch it yet. And so where did the money come from to fund and seed those institutional investors that do play in the cannabis space? Largely, it's high net worth individuals and family offices. Well, now you just look at where valuations have come from the highs of 2021. Many of those investments are underwater, and the likelihood of them realizing some type of positive ROI if they were to exit now or in the near term is very low. And so I think it's challenging to go raise new money. I think the equity markets are very, very constrained. And so the only real option left is debt. And to your point, I tell people I talk to, I think a PG, a personal guarantee, is kind of the ante. That's just the starting option. And then you have to have real assets, and you should expect the pricing to be incredibly high, which is interesting, right? Because you look at some of these headlines that I mentioned earlier, and a lot of them are driven by off-kilter balance sheets with too much debt on them. And the debt is high teens, low 20s, sometimes in excess of that on a yield to maturity basis because the debt has been so devalued. And so it's just, as a lender, and there are some really, really smart, I think very pragmatic, well-intentioned lenders out there that were trying to finance an industry towards what we all see as the vision of where it's going. But unfortunately, I think you're dealing with on average, a less sophisticated operator who we've encountered a number that in many cases have not done the requisite analysis to understand, is the project I'm financing able to repay that debt at that rate? Does the ROI make sense? And it just doesn't, unless there is this spectacular growth or federal rescheduling or something. And again, that's where it just hasn't come yet.
So it's hope
for
the future. It's hope for the future.
Build it, and the Fed, and they will come, or the Fed will change the rules or something, and it hasn't happened. And now you're dealing with looming maturity dates, and your burn rate is in excess of, what you've got in terms of runway or cash on the balance sheet, and you're out of options. And that's the challenge that I have. And I know Mike and I have talked about this, is that a lot of times when clients come to us, it's almost so late in the game that the options aren't really many. And that makes our lives very challenging. And it leads to a lot of difficult conversations for Mike and I, where we go, there isn't a silver bullet here. And we aren't magicians. We're just, guys trying to do a job, and it's tough.
And these issues get exasperated when you add tax liabilities to this. If you've got, California or the IRS breathing down your neck with an audit, and they say, hey, you owe us $2 million, in back taxes that you didn't pay, or, we disagree with your 280E calculations and now you owe all this money. Well, even if you come up with some sort of a payment plan and everything, that just adds to your debt that you already have, and you don't have enough cash flow to make this all continue to work.
Yeah. Here's the other thing that I've seen. So I'm a member of an LP, an investment LP for a large family office. And so I've got my money into this, and they came to me and said, hey, we'd like to make some cannabis investments. Will you be on the due diligence team to look at some of these companies that come about? I said, sure. So when I'm looking at these investments, like in my own businesses, when you've got 3 to 5 year projections, you're showing growth 3 to 5 years. And you're looking at these things and you're saying, wait a minute, I'm not sure I believe in that growth, because this is going to get to be a crowded market. As more and more licenses come in, you're almost seeing the ones who admit to it, right, and will do their projections, right? You're seeing them go sort of like this. They're going up, and then they're sort of leveling out, right? So it's one of those. So there's hope for the future with all these changes, but you also have to look at a business that's going to be facing substantial competitive headwinds as more and more licenses get approved, and the supply. Like, look what happened in California. So, I mean, we can look at New York as sort of the other side of that, right? Only 200 plus licenses. And then you look in California, where there's more cannabis dispensaries and operations than there are McDonald's. So, like, that seems to be a challenge as well. Like, how does an investor reconcile that?
Well, one other thing to keep in mind here is that these cannabis companies do not want to build a legacy company and have the next Hershey's of cannabis, or anything like that. Their exit strategy is 3 to 5 years tops. And COVID kind of put that on delay for at least 2 to 3 years, if not more. And so these companies just want to get to a certain top line revenue number, and then they want out. And then they want them out at a huge multiple, which that's just not going to happen, because many of them don't even have good books and records to support the numbers that they're showing to investors. So, you have all these complexities, in this industry that, people just want to get in and get out quickly and make a quick buck in it.
Now, do you see a difference in these transaction structures between vertically integrated companies and single state operators?
The ones that are single state operators tend to do better financially than some of these MSOs, because, as Colin pointed out, you're building this structure state by state, and it's just a waste of capital. But that's the only way that you can do this, in this current environment. So, you just end up duplicating many different things that if you had all of your grows from California shipped across the country, it'd be a whole lot more efficient than doing an indoor grow in New York City.
And it's interesting because, Qredible's not a plant touching company, but we deal with plant touching companies. We're on the CBD hemp side and the marijuana side and supplements and all that. But it seems to be that there's a difference in how an investor will potentially treat a non-plant touching company like some of these ancillary firms out there. What do you see that? Do you see that they're more positive and bullish on those companies, or do they just sort of lump everybody in the same category?
Yeah, I mean, it's they are different, right? If only because of the 280E impact and then the state regulatory environment in which they have to operate, and then the state tax environment. I mean, there's so many other layers of complexity that once you start touching the plant, it becomes really challenging. Now, you can argue those are barriers to entry and barriers to scale, and if you can really optimize for that environment, then you built something great. And I think there's a lot to that, right? But I think years ago, when I first started looking at this industry, my thought process was, and my background is business services and technology services. So I look at the ancillaries first and I go, it's the old cliche, we're going to sell the pickaxes to the miners, right? And I really like the technology that is fueling the industry. And I think that's going to lead to a greater level of sophistication and efficiency and profitability in the industry on the back of that technology. I like the infrastructure plays, like distribution. I like the outsourced sales and marketing elements to it. I really like all of the testing and the business services that goes into making it a safe and secure supply chain for consumers. I think there's a lot of tailwinds behind that are only going to improve and become stronger. So I think, yeah, there's a lot of reasons why investors look at how can I play this industry that's growing at a 30% CAGR, but do it in a capital efficient manner. That capital efficiency, I don't think I can underscore enough how important that is. You've seen over the last probably 2 or 3 years, more and more companies shifting to more of an asset light model. And in part, that's fueled by probably prudent operating and management decisions. In part, it's fueled by hubris and ego, which may feel counterintuitive. But let's take a moment and go, so many operators came into the industry originally years ago because they had passion for the plant. It was this emerging industry. And I think to Mike's point, they felt like it was going to be a quick way to make a lot of money. And in fact, a lot of people did make money very quickly early on. Only then did the industry sort of evolve and everything caught up. And we realized, no, it's really hard. And it is deceptively competitive and difficult to actually make money in the space. And so I think you have operators that they aspire to be, and the joke is, unfortunately, it's not as much of a joke. Probably once a week, somebody tells me they're building the Diageo of brands. And I see that in multiple investor decks, that same reference. And I think, how can everybody be building the Diageo of brands? It doesn't compute. And so there's this asset light, we're going to license our IP across the country. And I think there's some groups that can make that work, but it's very difficult to really build the brand and build equity value in that brand and be able to leverage that at scale versus some operators, certainly on the smaller end, that end up just sort of trying this national expansion on an IP basis, and they never really get consistency or quality, and they don't really develop anything. And so I think back to Mike's prior point, I think being a single state operator and being really focused on being efficient and profitable in your market and optimizing that one supply chain can be really, really valuable and really attractive to investors. But at the end of the day, it's not what I decide. It's not what Mike decides. It's what the market decides. And there's investors that like both. And they'll look for those opportunities in ancillary versus plant touching. They'll look for national versus single state. And it's just a matter of trying to find the right fit.
Well,
yeah.
And I also think that, now the operators are getting people from the food and beverage industry to lead these companies. In the early days of Colorado and California, Washington State, Oregon, whatever, it was someone that was passionate about, growing the plant. They really had a real passion for this industry. But that passion is really only good for, whatever it is that they know how to do, either to market the product or to grow the product, whatever.
Mhm.
They did not get an MBA, and learn how to run a multi-million-dollar business.
Mhm.
And their egos kind of get in the way. And I keep making the analogy of Steve Jobs, of how brilliant guy he was about, we didn't know what we needed, from a device. But he was fired from Apple, and so you can be brilliant at what you do, but still not be able to run a billion-dollar company.
Yeah, no, that's so true. And one of the things, I mean, look, I'm a picks and shovel tech company, right, in the space. And and our strategy has me, because I love the space. I really do. And I believe in its mid to long-term growth opportunities. But I also believe in not starving on the way to the banquet. So one of the things that we've been doing is, obviously we have other markets. So we're in nutraceuticals, and we're in CBD and hemp and those areas. And those areas are growing very nicely. But, frankly, that's sort of a hedge to the marijuana market as the marijuana market is maturing. Because, to your point, Mike, there's not a lot of people in the space that are jumping up and down saying, hey, we need quality management. We need all these professional operating systems, and we're going to do a digital transformation across the organization, because they're just not used to thinking that way. But we're seeing, it's like I said before, it's like the suits are entering the industry, and more of the professional operators, and I see it moving in that direction, where, particularly as 280E comes out, there's going to be more investment for these things. So as the mix changes of professional investors, which I think, professional operators, then we're going to also see more professional investors that are entering the space, because they're being run more like businesses. So I view personally, like, if you look at my our projections of our company, the growth has never been a hockey stick growth on the marijuana side. It's been a slower, steady growth on that side, which, we're getting great growth over in Canada. And I wanted to shift gears a little bit and talk about Canada, because, if you want to predict sort of what's going to happen if we were to go federal here in the US, you almost have to look at, okay, what's going on in the Canadian market. And surprisingly, when I was looking at those numbers, the sentiment towards Canadian cannabis has worsened. 39% of investors are becoming more bearish over the last 6 months, up from 29% from that last survey that was done in spring. And by the way, the group that puts this out is from Alberta, Canada. So, and 17% of respondents reported a net decrease in exposure to Canadian cannabis names. And there's many reasons that we've been studying that's driving that. And interesting, at Benzinga, the CEO of Organigram was one of the speakers there. So this is part of what's happening there, is there's people having less confidence in the legal market, and there's more people going back to the illegal market. I mean, there's a lot of reasons, particularly because the edibles are very weak in Canada, so more people are getting them from the illicit market than they are the legal market. But you're seeing the same thing in smokable flower. I mean, do you think that's a trend that we should be looking towards, and what's causing that, or any thoughts about the Canadian cannabis market?
I will be the first to admit I don't follow the Canadian cannabis market nearly closely enough to speak with any sort of authority. I think my understanding is that there's a lot of reasons why it's different than the US, in part just the way the government interacts with that particular industry, the level of regulation, the restrictions around marketing and branding, and so on, the THC content, differences. I think, look, at the end of the day, this industry has existed for decades. It's existed in levels of gray or illicit,
Mm-hmm.
and it's moving towards more of a legal. And until I think the legal framework can accept and accommodate kind of what the consumers have always demanded, and the demand has shifted, right? The profile has moved, but there's a yin and yang of the government putting restrictions and limits in order to try and guide consumption versus accepting that there is a level of consumption and demand for a type of product and then figuring out how to regulate that. And I think we see that in the US, that kind of push-pull. You see that from state to state, and I think you see Canada dealing with that to some degree as well. But there again, many of your listeners, I'm sure, will put me on blast and say I've completely missed it. And there are certainly, I acknowledge, far smarter people in the Canadian market than I am.
Yeah, no, I just find it interesting because, I mean, there's definitely a different parallel in their distribution model, obviously, than there is here. But, I think those are things we can look to make sure, as we're looking at a federal framework, that we're fixing some of those issues, because there's those that have gone before us. And, but I still think we're probably 5 to 10 years away from a true federal framework. That's just my opinion.
Well, and is that, I'm sorry to interrupt you, Brian, but I want to ask you a question. I mean, is that just a function of human nature that we struggle to kind of learn from others' mistakes until we make them ourselves? And I look at New York, and I think 2 years ago, I unpopularly made the comment that I think New York will probably go the way and look similar to California. It's challenging if it's not rolled out correctly, given that market. And I think, I'm not going to say whether it looks like California or not today, but I think there are those people that say New York has a lot of foreseeable challenges. Enforcement, the illicit market, did they just repeat history? And was that based on hubris? Was it based on lack of knowledge? Was it just human condition that we can't help? But until we learn from our own mistakes, we're destined to do them again. I don't know.
Well, it's interesting. We just had last week, we just had Herb Barbeau on, who was director of operations of the New York Cannabis Commission. And we talked a lot about that. And, they got 5,600, backlog licenses. They've got thousands of illicit stores just in New York City that they haven't been able to really do it. They've tried to levy fines, but guess what? Nobody's paying those fines. And they've got a whole mess of their own that they're trying to work through. And that's one of the things we talked about, is learning from what has happened in these other states to try to get it right. But I guess the time will tell whether that will happen. Mike, what are your thoughts?
Well, I think you got to throw in politics too with all of this, because, it's not like this is a new industry. I mean, Colorado started this over 10 years ago. And so there's been a number of states that have implemented, their own, rules and regs. And it should have been easy to take the best of all of these different states and combine it into one. But nobody wants to do that. They want to, do it on their own. And, quite frankly, one of the best states that I think has kind of worked it out, certainly from a tax perspective, is Missouri, because, they have a flat 6% tax. It's easy to administer. It's like a sales tax. There's not a lot of, hocus pocus, anything going on there. They were expecting to do 800 million, I think, of revenue last year, gross revenue. They did 1.8 million, not million, 1.8 billion in revenue. And so it's because if you make it where companies can actually, operate, then I think they'll be successful. And many of our clients in the Missouri market are just doing gangbusters. And they're getting all this cross-state customers as well that are coming over from Illinois and coming in from Michigan and other states that border them, because the taxes are less than half of what they are in these other states.
Yeah, hopefully they'll get it together, because that's another thing that is really impacting the price and the revenue flow of these businesses. And in that your example, I mean, you got people driving across state lines. You know, I mean, like in Ohio, another great example, very expensive in Ohio right now because they just released their program. And a friend of mine who lives in Ohio drives to Michigan, for his supply, and he'll stock up for like 3 months, and take a few hour drive. Like he'll drive 3 hours to go to Michigan because it's cheaper. And I think that, the states are really missing the boat and not realizing there's especially these significant border states, they're going to be really missing the boat on these things. And I always hate to ask professionals to sort of to tell the future, but I think it's important from this capital structure where we know that there's these small kind of family offices that might do equity deals right now. They're not big deals, but the true institutional money is using a lot of debt right now. We got to give our listeners sort of hope for the future. So as we see these things happening, how do you really see the deal structure changing and the types of instruments that are going to be used? Because if it's just debt, we're going to kill this industry. I mean, we're going to kill these companies. There's no way they can continue to support these debt burdens. I mean, they have to have the ability to truly see, equity security interests coming in to the market. What's your thought about that, Colin?
So I have reason to believe that there is a significant amount of capital that is waiting on the sidelines. I think the first trickle you're going to start to see is from some of that high net worth family office money. I think there are institutional investors that I have reason to believe are actively building SPVs or other facilities that have a curated list of LPs that allow them to come in and play in this industry. And at first, it may be the ancillaries. It may be those companies that are not technically plant touching, that don't have 280E exposure. I think if we look back a couple of years, there was a lot of enthusiasm for the industry, and you saw big strategics, particularly from the beverage industry, come in and start building their own products. You saw Molson Coors do a deal with Hexo. That has since terminated, and they've unwound that. I think a lot of those big strategics in alcohol, beverage, tobacco realized that, yes, the thesis is valid and this industry is going to mature and it's going to get there. And as we see in state by state, particularly on the alcohol side, as you see legalization, you start to see consumption and alcohol consumption decline almost in opposite, right? They're going to come in. It's only a matter of time. I think the early movers recognized they were too early. Mm-hmm. And again, we can't predict when the government's going to change, when the regulations are going to change. I think we would all agree we are more optimistic as we sit here today than we have ever been, that it's closer. But I mean, we can say that every day that goes by, we're at least one day closer. So I think it's coming. I think it will still be probably around the fringes, that ancillary space. I think you're right. It will have to move away from the debt markets. I think you may even see the debt markets get repriced. And I think that's where, if there is some brave souls that can put together a facility that come out and say, I've got 20 million, 30 million, 200 million of capital, let's go reprice that market, because you can drive 2 trucks through the difference between where traditional industries are and where the cannabis industry is. And the cannabis industry can't, on average, support the cost of capital for that type of debt. Well, then there's got to be something in between. Mm-hmm. And I think if we believe that markets are ultimately efficient, somebody will step in with capital. Somebody will fill that slot. It will probably be some level of secured debt. And I think we're starting to see some of that over the last 12 to 18 months with distressed funds that are coming in, and they're putting equity to work. They're coming in and they're right-sizing companies' balance sheets. It'll be interesting to see what happens with some of these debt providers that are now in a position where they are becoming operators, right? They are owning the businesses to which they lent to, and there is no exit for them. There is no liquidity event unless they can get in and roll their sleeves up and operate it better than the ones that they lent to. It's interesting. I think it's going to be a slow shift. I think the catalyst very well could be the rescheduling. But again, I don't see cost of capital resetting to normal rates, but it will move in the right direction.
Well, one of the companies I was talking to had a tremendous amount of debt, and they said, well, don't worry, we're going to raise equity. And and we're going to pay off that debt. And I said, well, you only got one problem there. Investors don't like putting money into a company so it goes out the back door.
Well, yeah, and that was, I kind of alluded to this earlier, right, when we were talking about the tax obligations and these accrued liabilities. So I've had a number of cases where someone's come to me and said, I want to go raise debt. And my point is, or I want to go raise capital. My point is, well, you don't have any balance sheet and you already have too much debt. No one's going to come in behind that. And there's nobody on the equity side that necessarily wants to sit behind that debt load. So it's very, very challenging. And then they say, well, fine, then I'm tired. I'm over this. It's way harder than I thought it was going to be. Help me sell the company. And I go, but it trades here and you've got this much debt and this much tax liability. It doesn't pencil. It can't work. Or just tax liability alone, that's an obligation the buyer is not going to take. You're going to get left with that and all of your proceeds go out to pay that. Best we can do is get you out even, and you basically turn over the keys. That's not what a lot of businesses want to hear, but unfortunately, because of what we've lived through in the last however many years, depending on your state, that's the reality. Very.
Maybe they get two bites at the apple, right? They get some type of earnout, in the. I could see that maybe happening, so that at least they don't walk away with nothing, but they can stay involved in a transition and in the future and get sort of another bite at the apple in future earnings.
Yeah, well, that's your point around what kind of structures are you seeing, right?
Right.
So right now, equities very rarely done. Check sizes are typically on the smallish side, oftentimes coming from high net worth family offices, private money, just because that's the way funds are structured with their LPs, is that they're prevented from investing in the space. Debt, largely all senior secured, backed by commercial real estate. The other pieces of collateral don't hold much value anymore. And even then, capital raise, very, very hard to get done. M&A can get done, but we're seeing deals where cash is very expensive. And so if you're going to take a pretty dramatic haircut on valuation, if you're trying to get more cash up front. So in many cases, they're very highly structured. That could be earnouts, that could be seller notes. It could be a variety of different mechanisms we can use in order to sort of share in that risk post-transaction. And that's really what it comes down to, is the buyers don't want to put their capital at risk in an industry which has proven itself to be very dynamic and very difficult. And so they want to share in that and say, look, if we win, we win together, right? But if we lose, we got to share in some of that too. And so I think you're seeing that play out in how deals are actually getting done.
That's awesome. Well, you both of you are two of my favorite people for your respective disciplines, because you've got a very educated and pragmatic view of this, and you're helping people navigate these very, very difficult waters right now, and you're not blowing smoke at them. Like, you're giving them the reality, you're helping them navigate and get the deals done that they can get done. And I think that's very valuable in this industry. So with that, Colin, why don't you sort of talk about how folks can get in touch with you and the kind of companies that you're working with?
Yeah, so I'm at Campbell at campfireadvisors.com. I'm also on LinkedIn, though I have not posted as much recently. But we're looking for companies that are in business services, technology services, and emerging industries. And emerging industries is cannabis. I mean, I think that's one of the most obvious. We're very bullish on cannabis in particular, but we have a breadth of businesses that we work with. Size-wise, it's a range. I would define it as lower middle market to middle market, just given our heritage coming out of some bigger shops. But we recognize that cannabis is an example of an industry that, a big cannabis operator is still constrained for all of the obvious reasons. So we built Campfire to be flexible, to be dynamic, to meet clients where they're at, and to, deliver a solution that fits their needs, and not just a single solution where if all you have is a hammer, everything looks like a nail. That's not what we're intending to do, right?
That's perfect. Mike, how about you?
So you can reach me at mike.goral@armaninollp.com. and also on LinkedIn as well. And our firm really looks at, this industry in a way like these small companies can become big companies if their brand or whatever, pops. We have worked with some small companies in California in the early days that had only like maybe one dispensary or something. Now they're a big MSO. They're across the country, and you just never know who's going to be that next big one. And so we work with all sizes of cannabis companies and help them scale. And we help them, go through this transition because we've done it so many different times in so many different states that we kind of know what works and what doesn't work. And one of the biggest things is that they just got to get their books and records, done correctly from the get-go, because at some point, when they do get, let's say, some sort of, interest from an investor or maybe even wants to buy them out, well, that data room needs to be stocked with, information that is true and correct, and if they needed an audit or something, well, you got to go back 2 years and then you got to figure out the cash, beginning inventory, ending inventory. That is a huge process. So the sooner you start with getting good books and records, that helps with me doing the tax returns. We've got an IT team that can help automate some of this data so that, your POS system ties with your ERP system, with metric, with, your financial reporting system. And that's how you're going to be successful.
Absolutely. Amen. And Colin, Mike, thank you so much for joining this today. This has been a very amazing topic and amazing discussion. And for our credible listeners, join us next week. Next Friday, we'll be talking about the intricacies of merchants in the CBD space and dealing with payment processing and the best practices to keep you out of trouble. Thanks very much for joining us. We'll see you next week.